Weak jobs report sending Wall Street lower for a fifth straight day on Friday. Let's get more on the jobs report and the market outlook. We're joined by Chad Morganlander. He's a senior portfolio manager at Washington Crossing Advisors. Welcome back, Chad. Jobs report said to be the weakest in nearly 1.5 years. Just 20,000 jobs created in February, 1/6 of what Wall Street had been expecting. Is it as bad as it looks?
I don't believe it is as bad as it looks. I think you have to take a 3-month moving trend, and sometimes you have these jobs reports where it's a data glitch. So I'm a little bit somewhat more curious to see what happens over the next month or so when it comes to the monthly jobs numbers.
Meaning there could be upward revisions.
I think there could be upward revisions. There's a lot of noise in it because of the government shutdown. Yes, they did have a nice surprise when it came to wage growth, but overall, I think you have to really take a big picture perspective on the jobs numbers.
And that wage growth, the largest since 2009. What do you make of the market's moves? The past 5 days have been down. You got the Dow Transports down for the 11th day in a row. You've got Wall Street down for 5 straight days. S&P and the NASDAQ down below their 200-day moving averages. So where do we go from here?
So Fred, this is an interesting type of scenario where you have global growth that's starting to decelerate. This week you had the OECD moderate their expectations for 2019. We wouldn't be surprised to see global GDP go from 3.5%, where the expectations are, down below 3%, perhaps 2.75. This is on the back of a couple of issues. China, for example, is trying to get their arms around that debt growth machine that we've spoke about in the past, and they're starting to moderate that growth. That is feeding into global trade, which is affecting the European Union as well as moderately the United States.
And the way you see it, you see a possible comeback in the second half for growth?
Well, we're not looking for a tremendous bounce back here in the United States, but nonetheless, we're not overly pessimistic. We believe that GDP in the United States could be roughly between 2 to 2.5%. A couple of positive things to think about is worker productivity has been quite strong, and that's one thing that bodes well for the United States. You do have, though, capital investment that has been disappointing, as well as labor growth has been disappointing. So you have some issues in the short term and the intermediate term in the United States, and many of them are quite structural.
Now, you've changed your asset allocations. Equities now modest underweight.
Yes.
What led you to that?
So
what are you saying?
Yeah, our expectation is that you're going to continue to see the equity markets here in the United States struggle for return, that we're in a lower return environment, and that as the global economy moderates or decelerates, that United States Treasuries and interest rates on the long end of the curve will be more attractive. So we would be actually allocating more into bonds at this inflection point. What we're seeing, though, is that you're also on the equity side could see a deceleration of earnings growth and revenue growth expectations. You could hear that earnings recession story pop back up again on every conversation that you have about the overall markets, which is giving us the reason for us being somewhat more circumspect about risk.
I see. So perhaps take some profit on equities. What kind of bonds are you recommending?
Well, highest quality bonds at this point in time. We would also look at U.S. Treasuries, look out on the curve at 10 years or above. We would be underweight high yield debt. And for the risk takers out there that are in emerging market debt, they've done very well at the beginning of this year. We'd scale that back and fade that trade.
The terms for the Treasury, 10 years or longer.
Yeah, absolutely. Our expectation is that if you get into a slowdown here in the United States and the Federal Reserve has to start moderating their growth expectations, that you could see a greater inversion of the curve, where you could have the 10-year go to 2.25.
Wow, 2.25, huh? Okay. Senator Elizabeth Warren, she's in the news today. She says that if she's elected president, that she'll put out a regulatory plan that'll break up some of the big titans, such as Amazon.com. Facebook, Alphabet's Google. How should investors prepare their portfolios as we get into the thick of election season?
Well, this happens every election season, where you start to get candidates that are proposing many interesting scenarios. Our opinion is that if you're a long-term investor, ignore it all. Be very careful about getting caught up in the daily rhetoric that happens by many of the politicians, because many of these ideas don't come out and they don't pan out. So we would look at an investor and say, look 5 to 10 years out and make sure that your portfolio at this point in time in the economic cycle is in steady Eddie companies if you're on the equity side, and high quality bonds if you want some fixed income.
So you wouldn't make moves such as, okay, let's lighten up on pharmaceuticals, parts that may be exposed to political pressure. Just stay the course.
Well, we've seen this scenario before in the 90s with Bill Clinton, and as well in the early part of 2000. And what we've all noticed about this is that, for example, in healthcare became just a greater portion of GDP, and it was a wonderful place to invest over the long run. So the long-term viewpoint from our perspective, from a structural perspective, is that it'll continue to become a large portion of global GDP.
And this tells me that it's time to end our show. Apologies with the phone ringing. And thanks a lot, Chad.
Thank you, Fred.
Our thanks to Chad Morganlander of Washington Crossing Advisors. I'm Fred Katayama, and this is Reuters.